The UK property market is changing. Mortgage rules loosened, listings surging, landlords exiting, and corporates keep buying. And new tax ideas are circling. If you own, rent, or you're trying to buy, the next 6 to 12 months won't look like the last 6 to 12 months. Today, I'll show you the 5 shifts most people are missing, the single data point I think unlocks the 2025-2026 market, and what to do now, whether you're a homeowner, first-time buyer, or landlord. And for quick context on why you should bother listening to me, I founded British Homebuyers and British Homesellers back in 2013. My teams have managed thousands of transactions totaling over £5 billion of property sales. Day to day, I'm in the data and in the deals, and I'm not here to scare you, I'm here to show you what the numbers are actually saying. So, what will you get from this video? I'm sharing what actually changed in mortgages and why that matters more than one headline rate cut. Why supply is up, but that doesn't mean cheap houses for all. The landlord exit versus corporate consolidation story without the tinfoil. The tax ideas that could reshape incentives, and a playbook for owners, buyers, landlords and renters for the next 6 to 12 months. And all I ask is, if at any time you find this information useful, tap like so YouTube shows this to more UK viewers like you who you think may need to see it. So let's talk about the mortgage rules quietly being loosened. For years, lenders stress tested your affordability at reversion rates plus a buffer, even when the actual 2 to 5 year fix you'd get was much lower. This excluded thousands who could genuinely afford real world payments but were denied because of these tests. So what's changed is regulators signalled lenders can use more realistic forward views rather than perpetual worst case doomsday scenarios. That high loan to income flow limits now only apply to bigger lenders. Smaller lenders have more room to offer 4.5 to 5.5 times income in the right cases. Remortgage switching got simpler, overpayments and term changes are getting easier to action. The bottom line is this is credit loosening, not a free-for-all, but enough to pull marginal buyers back in and support transactions. In a constrained supply market, easier credit rarely lowers prices, really it usually props them up. So let's talk about why supply is up, but not for the reason you'd think. We've had the highest number of homes listed in years. Great, right? More choice, except demand has risen less than supply. So why the divergence? Many 2020-2021 ultra cheap fixes are expiring. The new payment reality shocks owners who stretched at 1 to 2%. So some can't refinance easily, even with lower tests, and are forced to choose to sell instead. The next is budget noise, creating pause buttons for people. People delay 3 months to see what happens. That stacks demand, then releases it in a lump. More in what I mean by this in a moment. So what are the key implications here? Time on market stretches, price reductions tick up, and buyers get negotiating power if they can pass affordability. But a surge of motivated sellers doesn't equal a crash when credit is loosening at the same time. It equals churn, more sales being agreed, more fall-throughs, more price reductions. And so it's no surprise that price reductions on properties on the market have hit a record high this year, a 17.8% increase on last year. What is contributing to this is the landlord exit versus corporate consolidation. Yes, small landlords have been exiting for years. Section 24, higher stamp duty surcharge, compliance costs, EPC uncertainties, now the Renters' Rights Act rollout. It means margins squeezed, headspace squeezed. Many older landlords take the win now and de-risk. The median age of individual landlords is 59 years old. But what fills the gap is 2 things. One, build to rent and institutional capital taking whole blocks focused on yield more than capital appreciation. And secondly, large portfolio landlords with systems who can absorb compliance at scale. Why it matters to tenants is Small landlords are statistically more likely to hold rents for good tenants and be flexible. Larger institutional owners price by algorithm and policy, not relationship. That's not evil, it's just how big operators run. Why it matters to investors is yield resilience and operational excellence matter more than ever now. If you stay in the game, you're competing with scale on sourcing and management, not just financing. So the reality check here is this is a matter of policy increasing, costs increasing, more capital needed to compete increasing. And what does that add up to? Well, when rules get heavier, scale wins. We've seen this on every high street, in every high street category. Walk down the high street. How much of it is dominated by national or multinational brands compared to independents? Is that a good or bad thing for society as a whole? Let's talk about the tax ideas that are changing behaviour right now, even before they're real. Nothing's actually happened yet. There are a few ideas doing the rounds at the moment. First is seller's stamp duty trials, so flipping who pays stamp duty on sale instead of purchase, an annual property land value levy replacing or supplementing council tax, stamp duty, so on. £500,000 property value thresholds are being floated around in the press on that. National insurance or rental income for individuals, company-held properties are unaffected. Capital gains tax tweaks and allowance changes. The point isn't certainty of all this, it's anticipation. Buyers and sellers pause. That creates pent-up demand and a short-term listings bulge. Then post-announcement, whatever the outcome, most people make the same decision they were going to make anyway, just later. So cue a new year release valve, because I honestly think we're going to see a rush of activity start of December, rebooting strongly start of the new year, and we'll see the momentum slow down inevitably through next year. I could be wrong, but I did correctly predict house prices would boom over COVID, that they would struggle after COVID. This isn't rocket science. If you add liquidity into the market, prices rise. If you take liquidity out of the market, prices slow or fall. If you create uncertainty, people delay decisions. It builds pent-up demand that gets released at some point. Your edge in this situation is planned for timing volatility, not just pricing volatility. Next, I think it's important I talk about the silent price story, inflation versus nominal pricing. So national house prices look flat to up a bit in nominal terms, but inflation adjusted, the last few years have delivered a real terms drop in house prices. That's why it can feel like a slog even when the headlines say prices are up 2 or 3%. For buyers, your affordability pain isn't just the sticker price, it's rates plus living costs. For owners, don't get drunk on nominal gains, look at real equity and cash flow. For landlords, your real return is net yield, real costs, and capital growth is a bonus, not just the base case. So let's talk about the why now moment, post-budget pent-up demand. Here's the tell I'm watching for right now. Decision deferral into the autumn budget. A big chunk of would-be movers pause into late November. In my experience, most of those households, like I've said, are going to proceed anyway once they have clarity, even if policy outcomes aren't what they wanted. What that produces is a January-February spike in viewings, offers and agreed sales, a tug of war between more motivated sellers and credit-supported return of buyers. Regional uneven outcomes, the North and Midlands are more resilient on affordability. London and the South East are a lot more price sensitive. Just don't be surprised if Q1 looks busier than Q4 next year without needing a rate cut fireworks display. So let me share my playbook on all of this. If you're a homeowner, price to the market you're in, not the one you wish you were in. The first 14 to 30 days are crucial. Get conveyancer instructed up front, pre-prep, ID, title docs, property information forms. Getting that done will shave weeks off the conveyance once it sells. If upsizing, remember, a 2 to 3% market move matters more on the buy side than on your sale. Don't lose a good onward because you're haggling a small percentage on the way out. For first-time buyers, plan affordability based on your maximum monthly payment you can live with at today's actual mortgage products, not wishful rates of the future. And broker hop, check 2 independent brokers, because smaller lenders now have more flexibility on mortgage products they can offer. And for landlords, whether you're staying or exiting, if you're staying, re-underwrite your portfolio at stress tested rates you can actually get today and lock the weakest links in first. Systemize inspections, arrears flows, have a compliance calendar. Yield is what's left after operations, and hunt micro markets where gross yields still clear 7-8% with realistic operational expenses. If you're exiting, decide now whether you want to hit the Q1 demand bump. Line up your documents, get photos, legals prepared, avoid dead time. Model capital gains tax plus selling costs versus a managed disposal over 12 to 18 months. For renters, ask your landlord for a 12 to 24 month fixed contract. Stability, of course, as we know, has value. And if you can buy, don't panic buy. Use your strong purchasing position of being chain free to secure a good price. In conclusion, the UK housing market just changed, but not in a way that demands panic. Credit is slowly loosening. Supply is up for stressful reasons. Small landlords are thinning out while big players scale up. Tax talk is creating a timing wobble that likely will be released in Q1. If you're clear on your numbers, your time horizon, and you move deliberately, you can still make very good decisions in this market. I'll keep bringing you real world data and information insights. If this helped, hit subscribe and share this with someone who's stuck in decision limbo. I'll see you in the next video up here.